Here's a full-blown breakdown on why you don't need 10%, even sometimes 20% cash saved to buy a business with an SBA loan. The numbers work, the seller's ready. Down payment gap is not the deal killer. Most people think get fair up it and right up under it. So a good deal is right in front of you. Found a bit worth buying. The SBA loan can cover most of the purchase price, but the 10-20% equity injection you're supposed to bring yourself, it's not sitting in the savings account. So you assume the deal's dead, or you walk away thinking you need another year or two to save it up. So a good deal shows up, right business, the right seller, the right moment. SBA covers most of it. The loan handles the heavy lifting and the purchase price. The injection doesn't exist. 10 to 20% in equity saved in bank as cash isn't sitting there. The deal feels dead. So why waiting? The market won't wait for your savings account. There is a massive wave of small business owners hitting retirement age right now. I think they call it the silver tsunami, and they're selling. They're trying to sell. Most of them will go unsold, which is why we're getting deals for a song right now, ladies and gentlemen. Why we're getting deals for a song right now, ladies and gentlemen, good deals do not sit around. If you spend the next year saving up the injection, the business you want is very likely sold to someone who figured out how to fund it without waiting. So timing's everything. Best deals close in weeks, not months. A year of saving is a year of losing. Retiring owners are selling now. A generational wave of small business is underway. Supply is high, but ready buyers are scarce. Fast buyers win. Buyer who already has their funding sorted, the one who walks away with the deal and pumping hard. So here's the basics, what you actually need to bring. The equity injection is typically 10 to 20% of the total project costs, not just the loan amount, the full cost of the deal. The SBA is particular about where that money actually comes from and how it's documented. Particular does not mean impossible. It means there's a right way to structure it, and that's exactly what most buyers miss. So quick numbers, a $500K deal, you're going to need 50 to 100K. $1 million deal, you're going to need 1 to 200K. So it must be documented and correctly sourced. And here's the 3 ways people actually cover this. There's 3 real past buyers used to fund the equity injection without draining a savings account. Each one has its own requirements and its own limitations. So a gift from family, step 1. A family member gifts the funds, requires a signed letter of proof, is not a loan in disguise, plus documentation to transfer. Rob's rollover, moves retirement account funds into a deal through a specific legal structure, requires a specialist to set it up correctly, can move a little slower. Or there's the HELOC, draws on equity already sitting in a home or property you own, no family needed, no retirement balance required. So here's the catch, 2 of those depend on someone else. Look closely at the first 2 options and you'll notice a pattern. Neither one is fully in your control. Gift needs willing family. Someone has to be both willing and financially able to give it, and that's not a conversation you can force or a timeline you can control. Rob needs a big enough balance. So you need a retirement account with enough in it to make the structure worthwhile, plus a specialist's time and fees to execute it properly. Neither is on your own schedule. Both options introduce external dependencies and can delay or derail a deal that otherwise makes complete sense. So why the HELOC is different? Here's the big lever. What makes it stand apart? No family conversation required, no minimum retirement balance, no waiting on someone else's decision, control the timeline. A HELOC depends on exactly one thing. Equity already sitting in a home or property you own, LLC-owned investment, nothing else. If the equity's there, the path forward is yours to control. No external approvals, no awkward asks, no specialist. This is the option that puts the deal back in your hands. So let's look closer here, ladies and gents. Condition. The one requirement you have to meet. You must be able to cover the HELOC payment with income that has nothing to do with the business you're buying. So a job, a spouse's income, another property, something already in place, completely separate from the acquisition, not relying on the future revenue of the business you're buying. If that income exists, the HELOC counts towards your injection. If it does not, this path is not the right, and one of the other 2 options deserves a closer look. This is the single detail that decides whether a HELOC strategy works for your deal. Know your answer before you start the conversation with an SBA lender. What this looks like in practice, 3 moves to make before you ever sit down with an SBA lender. Get these right and you walk in with the injection already solved. Assess the equity in your property. Verify the income so your DTI isn't through the roof. Line up a HELOC. Arriving at the SBA conversation with your injection already sorted, knowing their requirements, not still figuring it out, is what separates buyers who close from buyers who stall. Now, market timing. Why this matters right now. So 10,000 plus owners selling daily. Baby boomer business owners are exiting the market at a record pace. Zero extra savings required. If your equity and outside income qualify, you don't need cash reserves. Weeks, how fast deals move. Good deals close fast. Funding readiness is what lets you compete. There's no lack of opportunity out there. There's a lack of preparedness. There are more owners looking to sell than there are buyers ready to act. Buyers who move fast are closing these businesses. Having your funding sorted before you fund the deal is what lets you be that buyer. So, how we help. This is the piece we help you work through. We structure the HELOC side of this directly using the same equity strategy we apply to real estate deals, pointed at a business acquisition instead. We look at your numbers, tell you whether this path works, and help you get it set up before you approach an SBA lender. And if your numbers don't support this path, we'll tell you straight up and point you toward the option that actually fits your situation, if any options at all. What we do, structure the HELOC correctly, evaluate your equity position, confirm outside income coverage, match you to the right path. So, ready to find out where you stand. If you have a deal on the table and the down payment is the only thing standing between you and closing, let's look at your numbers. Head over to gapfunded/apply. Book a call with our team. We'll review your equity position and tell you exactly where you stand. Digital lenders are moving as fast as 5 days to get funded on a HELOC now. So book your call at gapfunded/apply, link in the description below. Gap funded, we're talking days, not weeks. Not having cash saved doesn't mean the deal's dead. It means you haven't found the right lever yet. If this helped, there's more walking through exactly how buyers are closing deals without draining their own savings. Buyer who figures out the injection wins the deal. The one who waits to save it up loses. I'm Mick Wadley. Let's go close something. If you adored this video, smack the subscribe and flock the bell, and I'll see you on the next one.